Hello everyone. This is Amit Kumar, and I'll discuss with you the concept of pooling of interest and purchase goodwill method. That in goodwill calculation, what is pooling of interest? And purchase goodwill. So we currently use purchase goodwill method in Ind AS 103 business combinations. So Ind AS 103 business combinations is a standard applicable for calculation of goodwill and valuation of NCI. NCI is non-controlling interest. So if I go back a little, what was pooling of interest? In pooling of interest method, when an entity was acquired, it was time of comparison. So the purchase consideration to acquire an entity was compared with book values of net assets acquired. Suppose fair value to acquire an entity is 5 lakh and the book values are 300,000. So the difference was recognized as goodwill Now, if you notice, by measuring it at book values, the goodwill is highly inflated because we have not taken into account the fair value of net assets. We have not fair valued them while acquiring this entity. We have compared directly what we paid with the book values of net assets. And the goodwill so recorded was amortized in India over a period of 5 years. The same in US was being amortized over a period of 40 years. So this was eliminated, or this was removed with the introduction of purchase goodwill method, that when we are acquiring another entity, we should not just place a value on the entity as a whole, but we should also fair value the net assets of that entity. So the purchase consideration and the goodwill calculation changed a little. It moved from book values of net assets acquired. Suppose if we acquired 80% share and the fair values of net assets, the fair value of net assets of a subsidiary are suppose 4,50,000. So 80% of this, 4,50,000 was recognized as goodwill. So if you notice the difference, like the difference is, we were comparing earlier 3 lakh as book values, but now when we fair valued the net assets, we got to know that the fair value is higher. It is 3,60,000. Earlier also we were comparing what we were acquiring, like we were not comparing it with the entity as a whole. What we acquired, we were comparing. If we acquired 80% of an entity, we were comparing it with the 80% of the net assets acquired, 80% of the book values, and we were recording the goodwill. this was not considered very fair. So we changed the method to purchase goodwill method, wherein we started fair value of net assets of subsidiary, fair value of net assets of a subsidiary acquired. So this was the manner of presentation. Now the goodwill so calculated was belonging to parent only, because we were comparing 80% with 80%, that we were acquiring 80% of the shares, we compared with 80% of net assets acquired. So this goodwill was belonging to parent only goodwill, parent's goodwill. And in this case, we were valuing non-controlling interest at proportionate share of net assets. This was also not considered very fair, because we started measuring the net assets of subsidiary at fair value, but we were still valuing NCI at proportionate share of net assets. So this was also not liked by the advocates of accounting, who wanted fairer presentation for NCI as well, non-controlling interest as well. They wanted that we want NCI also to be valued at fair value. Since you are valuing 80% at the fair value of net assets, why don't you value the remaining 20% NCI also at fair value? So a choice was introduced to value non-controlling interest, also known as NCI, either at proportionate share of net assets or on fair value basis, that is on the basis of fair value of the share. This is known as fair value basis. So the manner of presentation changed with the introduction of this. The manner of presentation which you are directly comparing purchase consideration with the fair value of net assets acquired, the manner of presentation has changed to now we'll be presenting it like this. The manner of presentation for calculation of goodwill has changed to, we'll say, the purchase consideration which we are paying to acquire 80%, in it will include the value of NCI, proportionate basis or fair value basis. So we'll have to value it on either of the two. The reason why this manner of presentation is changing, so that we can present on the face what is the value of NCI, and then we are now comparing it with fair value of net assets of subsidiary. Instead of saying what we have acquired, we are presenting on the face what is the fair value of net assets subsidiary. We are presenting it 100%. So if we do it in this manner, then the purchase consideration which we were paying 80% was equal to 5 lakh, and if I value NCI on proportionate basis, value of NCI on proportionate basis, 20% share, we'll get to know from the 20% of net assets of subsidiary. So the fair value of net assets of subsidiary in full is equal to the fair value of net asset subsidy. In our previous example, we took them at 4,50,000 is the fair value of net asset subsidy. So if you need to value NCI, we'll be valuing it at 20% of it, that is 20% of fair value of net asset subsidy. When we compare this now, the goodwill we get is 5 lakh representing 80%, 90,000 representing 20%, minus 4,50,000. The goodwill turns out to be 1,40,000. So if you notice, there is no change between this manner of presentation. Whether we present it like this or whether we were presenting directly, there is no change in it as far as purchase goodwill method is concerned. And for calling it parents goodwill only, the reason for calling it parents goodwill is that this is the way we were calculating the goodwill which was belonging to parent only, which was turning out to be 1,40,000 when we compared the purchase consideration for fair value of net assets acquired. The only thing we have done now is we have simply changed the manner of presentation, just included 20% and 20% value of NCI as well, and then compared it with 100% fair value of net assets. So whether you calculate, now this is simple maths, whether you calculate in this manner or whether you calculate according to this method, the goodwill which is calculated is belonging to parent only. So I purposely done this to prove that why it is known as parents goodwill. What's the reason behind it? Parents goodwill. So this is belonging to parent only, also known as partial goodwill. But the same thing when we do, when we value NCI on fair value basis. So the same thing we try to value now NCI on fair value basis. Purchase consideration to acquire 80% is 5 lakh. Value of NCI on proportionate basis is 20%, but this 20% will not represent 20% net asset subsidy, but it will be on fair value basis now. So if there are, suppose the entity's share capital was 100,000 shares and 20% of 100,000 is 20,000 shares. The value of each share is 20,000 into, I suppose it to be 6 per share. So the total value of NCI turns out to be 1,20,000 now. And fair value of net asset subsidy at this point is equal to 4,50,000. So the change in goodwill, if you noticed, from 1,40,000 to 1,70,000 makes it full goodwill belonging to parent as well as NCI. The difference between partial goodwill and full goodwill is of 30,000, and this happened because of valuing NCI differently. We were valuing NCI on proportionate basis, which turned out to be 90,000. Now we are valuing NCI on fair value basis. The difference between these two valuations is 30,000. Value of NCI on proportionate basis is 90,000. Value of NCI on fair value basis is 1,20,000. This difference of 30,000 has resulted in valuing goodwill differently. Now what impact does it have on the balance sheet and later impairment? Now if the goodwill impairs in future, now this is full goodwill. The only thing which has changed is the manner of presentation, and it's about time, like the calculation of goodwill is changing with time. There are thought leaders like who share their insights on its fairness. So it has moved on from pooling of interest, which was directly comparing the purchase consideration with book values, and we were amortizing it over a period of 5 years. It has moved on to purchase goodwill method, wherein we started comparing with it with the fair value of net assets acquired. Later on, to make it more fair, we included the choice to value NCI at fair value, which resulted in changing the manner of presentation to this way. And if we include value of NCI on proportionate basis, the goodwill so calculated is known as partial goodwill belonging to parent only, which means that in future, if goodwill impairs, if there is any impairment on goodwill, we will charge impairment loss only to the group retained earnings, only from the parent's perspective. But if the goodwill gets impaired, which is belonging to parent as well as NCI, will not only charge impairment loss to group retained earnings, but will also charge an impairment loss belonging to NCI as well. So that's the impact it will have on future accounting when there is an impairment loss. Now another big change is that goodwill is no more amortized. Goodwill is no more amortized. Goodwill is assumed to have indefinite life. So goodwill will be tested for impairment annually, regardless of indicators of impairment. Why it is stressed upon regardless of indicators of impairment? Because in Ind AS 36, impairment of assets requires external indicators and internal indicators to trigger testing for impairment, wherein we compare carrying amount with the recoverable amount. But in case of goodwill, there are three such cases. One is goodwill, one is intangible assets with indefinite life, intangible assets not yet available for use. They all are tested for impairment annually, regardless of indicators of impairment. So goodwill is one among them. And if any impairment loss is charged, reversal of goodwill is not allowed. Reversal of goodwill is not allowed, because reversal of goodwill will be treated in the same manner as internally generated goodwill. So internally generated goodwill is not recognized. Only purchased goodwill gets recognition. So reversal is treated as internally generated, and there is no basis of valuation for internally generated goodwill. Is the reason we do not recognize it. We only recognize the purchased goodwill as part of the balance sheet. Then future, if goodwill gets impaired, on impairment of goodwill, suppose we are comparing the carrying amount of a CGU with the recoverable amount of a CGU. The carrying amount of a CGU without goodwill is, say, 8 lakhs, and recoverable amount of CGU is 6 lakh. So there is an impairment loss of 2 lakh. If the goodwill is belonging to parent as well as NCI, the impairment loss is charged to parent as well as NCI. Suppose the goodwill allocated to this is The goodwill, this is without goodwill. I'm taken without goodwill. In that case, we'll apply the principles of Ind AS 36 impairment of assets. But if it is with goodwill, and the goodwill allocated within CGU is, suppose there was only one CGU and we allocated goodwill on fair value basis to be 170,000. Is the goodwill allocated to it? So when we are impairing a CGU with goodwill, the hierarchy for impairment of CGU with goodwill is, first we deduct the value of an asset within CGU which is specifically impaired. Second, we eliminate goodwill to the extent possible. And third, we charge the remaining impairment loss to other assets within CGU on pro rata basis. Suppose the goodwill in this example impaired, the goodwill which is belonging to parent as well as NCI, the impairment loss charged to goodwill will be 170. Suppose we are impairing full. So if parent share is 80%, we'll charge 80% of it to the parent. 80% of 170,000 will be charged to the parent. The remaining 20% of it will be charged to NCI. So the entry will be goodwill account credit, group retained earnings, debit, non-controlling interest debit, and will impair goodwill if the goodwill gets eliminated in full. So in case of full goodwill, parent plus NCI both are being charged with the impairment loss. But if the goodwill calculated was partial goodwill, suppose we had partial goodwill, valued at 140,000. So this 140,000 is representing parent only. So for the purpose of impairment testing, we need to gross up the goodwill and calculate notional goodwill for impairment testing. So if we gross up the goodwill, grossing up the goodwill is 1,40,000 is representing 80%. 100% of it will be 175,000 will be the grossing up of the goodwill. We'll add this as part of the recoverable amount. So the carrying amount of with goodwill, which included 170. Now if we take the same, the previous value included 170 as goodwill. So that means the carrying amount was 800,000 minus 170 plus 175,000, the grossed up goodwill. So we are including partial goodwill here. If we include partial goodwill, this 8 lakh included the full goodwill, which was 170. But when we grossed up the goodwill, we need to include the grossed up goodwill for the purpose of impairment testing, and we got to know that impairment loss is actually 205,000. Now in this partial goodwill, the total impairment loss doesn't belong to the parent. Only a share of it belongs to the parent, which is 80% of 205,000. So the impairment loss eligible to be deducted is 80% of it. That is 164,000 is the impairment loss to be charged. So when we are calculating partial goodwill, and if there is any impairment loss, it has to be charged only to parent. So if it is supposed to be charged only to parent, since we have removed NCI from it, from the total impairment loss, the goodwill will be reduced by 164,000, and there will not be any charge to NCI because we did not calculate NCI's share in goodwill, and the entire goodwill belongs to parent only, and if goodwill gets impaired, group retained earnings gets impacted because of it. So that's the basic difference between partial goodwill and full goodwill. If I summarize it, in case of partial goodwill and full goodwill, partial goodwill is belonging to parent only. Full goodwill is belonging to parent plus NCI. On impairment, the impairment loss is charged to group retained earnings on impairment of full goodwill. Impairment loss is charged to parent as well as NCI. So just for the purpose of knowing the impairment loss, if we are testing for impairment, so testing for impairment requires grossing up of goodwill that is calculating notional goodwill. Notional goodwill, so that we charge fairly the impairment loss, though it is not charged to NCI, but we need to know what is the total impairment loss, including it to the carrying amount of the CGU which we are testing for impairment. When we get to the total impairment loss, we only charge the share belonging to it. So this is notionally calculated. This is based on notional. calculation, the grossing up is notional. This 175 is notional goodwill calculated. This is not existing as part of the balance sheet, but this is calculated only for the purpose of testing for impairment. If goodwill is valued at fair value basis, then there is no problem. The entire goodwill is belonging to parent plus NCI, and if there is any impairment loss, we are capable of allocating it between group retained earnings and NCI. Hope this makes sense. So the real reason behind bifurcating it into two parts is that if it impairs, who will bear the impairment loss? In case of partial goodwill, the impairment loss is only borne by the group retained earnings. In case of full goodwill, since we are allocating an amount to NCI as well, and NCI we are valuing it on fair value basis, if as a result of it, on the credit side of the balance sheet, the NCI is higher by 30,000. If on the credit side of the balance sheet, if NCI is higher by 30,000, on the debit side of the balance sheet, goodwill also increases from 140 to 170. So we can say that this increase in value of goodwill is belonging to NCI. So the goodwill so calculated is belonging to parent as well as NCI. So what you need to keep in mind is that if in future this goodwill gets impaired, which is likely to happen because goodwill is tested for impairment annually regardless of indicators of impairment. So if the goodwill gets impaired, if it is full goodwill, we need to charge impairment loss to parent as well as NCI. If it is partial goodwill, we need to charge impairment loss to parent only because the goodwill is entirely belonging to parent only. Now to reach this stage of calculation of goodwill, I have shared in my previous discussions 5-step methods to calculate goodwill, wherein I have shared how the 5 steps help in calculation of goodwill. And another important point I'm going to make here is that now valuation of NCI determines calculation of goodwill. If you notice, like we valued NCI either on fair value basis or either on proportionate share of net assets. So can I make the statement that valuation of NCI determines calculation of goodwill? So when you are dealing with calculation of goodwill, we need to follow the principles of Ind AS 103 business combinations. So I shared 5 steps with you, wherein these 5 steps helped us to calculate goodwill, calculate NCI, calculate the value of group retained earnings. The 5 steps I shared earlier with you is working note number 1 is group structure. So if you have been following my lectures, you will get to know about the 5 steps. What do I mean by 5 steps? And when I do my calculations, when I do my workings or explanations, I always use these workings in context, like that we'll be adjusting it in working note number 3, we'll be making the adjustment in working note number 4. So once you understand these 5 steps, looking at my other lectures which are specifically directed towards sharing the knowledge around the 5 steps to calculate goodwill NCI, which we use for the purpose of consolidation. So working note number 2 is net assets of subsidiary. Working note number 3 is calculation of goodwill. Working note number 4 is valuation of non-controlling interest. And working note number 5 is group retained earnings. So you could make out through my discussion that these are important workings even for consolidation procedures, and this covers a standard known as Ind AS 103 business combinations. So when we are identifying the group structure, we should be clear when did we acquire, because that's important, like who is the parent, how much is the share of NCI, what is date of acquisition, what is date of balance sheet. All this information helps us in knowing that what is the percentage we need to allocate to parent, what is the percentage we need to allocate to NCI. Date of acquisition is say 1st January 2019. Date of balance sheet is 31st December 2019. I'm taking it at the beginning of the year. Working note number 2 will help us in knowing the net assets, because then that net assets of subsidiary valuation is needed for calculation of goodwill. So how do we do that? Net assets of subsidiary, we calculate a date of acquisition and date of balance sheet. We need it of 2 dates. Suppose I include share capital is 100,000 on the date of acquisition which we acquired, 100,000 on the date of balance sheet. The retained earnings position when we acquired this entity, retained earnings position when we acquired this entity was suppose 50,000 and turns out to be 90,000 by the end of the year, or 70,000. On top of it, we need to do fair value adjustment. That's the requirement of Ind AS 103 business combinations, that we need to fair value the net assets. If you noticed, when we began this session, we said that if we are acquiring another entity, now we need to fair value the net assets. How that fair valuation is done? If land is higher by 40,000, we'll include land on the date of balance sheet. Land is non-depreciable, we'll include the same amount. If building was higher by 30,000, we'll see the remaining useful life of this building. If it is 5 years, we'll charge depreciation on the basis of 5 years. The date of balance sheet amount will be 24,000, charging 6,000 depreciation and 30,000 for 1 year. We identified a patent, the value of which is 20,000, and it has a life of 10 years. So we charge 2,000 depreciation, its value is 18,000. We identified an intangible asset not yet available for use, intangible asset in the development stage, and we valued it say 25,000. It is tested for impairment annually regardless of indicators of impairment. There is no depreciation or amortization charged on the intangible asset which is in the developing stage. Then we calculate deferred taxes on fair value adjustments. If the rate of tax is say 20% on all these fair value adjustments, 115,000, suppose 20% of 115,000 is the tax, 20% of 107,000 is deferred taxes. So when we calculate the total, we get to know the fair value of net asset subsidy on the date of acquisition and fair value of net asset subsidy on the date of balance sheet. The difference between these two amounts will give us the post acquisition profits. So the post acquisition profits are, which will be including as part of value of NCI and group retained earnings. The post acquisition profits are 255,600 minus 242,000. 13,600 is the post acquisition profit belonging to parent as well as NCI. Parent will get a share of 80% of 13,600. NCI will get a share of 20% of 13,600. 80% of 13,600 and 20% of 13,600. We did this calculation so that we get the fair value of net assets or subsidy on date of acquisition. We need this 242,000. This we require for goodwill calculations. For the purpose of this, we did this working note number 2. So when we move on, calculation of goodwill is the third working. So in calculation of goodwill, there are various ways we can buy an entity. So purchase consideration can be a combination of cash. Suppose we paid cash 1 lakh. There may be deferred consideration. Deferred consideration is, suppose 108,000 to be paid after 2 years at the rate of 8%. So what is the present value of it today? So we take the discounting factor for 2 years. The present value turns out to be 108,000 92593 is the value of deferred consideration. There may be stock exchange, there can be way of contingent consideration. Contingent consideration is say 20,000. According to the standard business combination, we also need to value contingent consideration. This contingent consideration should not be confused with Ind AS 37 provisions, contingent liabilities and contingent assets. This is a contingent consideration specifically applicable to Ind AS 103 business combinations, wherein if the seller promises good amount of revenue or growth in the company and they expect more value for selling their stake, the buyer is also smart. They include a contingent consideration that if it happens, we'll pay you more. So this contingent consideration is fair valued and is included as part of purchase consideration. There may be stock exchange, that for every 2 shares acquired, one share issued by parent. So the entity acquired 80,000 shares. For every 1 issued means 40,000 shares issued, and 40,000, if the fair value of entity's share is 4 per share, the total value to be included may be 40,000 into 4, 1,60,000. So if we total this becomes the, so I've taken all the ways through which we can purchase an entity. Just for your clarity, all the ways may not be necessarily applicable in buying every entity. It's just included for your information. So this is the total amount of purchase consideration. We'll need this information, the total of purchase consideration. We'll compare it with fair value of net assets of subsidiary, fair value of net assets of subsidiary. Before it, we'll need the value of NCI. Value of NCI, just for ease, I'll be taking it on proportionate basis. Fair value of net assets of subsidiary on date of acquisition. So fair value of net assets of subsidiary on date of acquisition is, we just calculated in working note number 2, 242,000. We can simply say we just did it in working note number 2. Value of NCI is 20% of this fair value of net assets, that is 242,000. It turns out to be equivalent to 48,400. So the goodwill so calculated, so if it turns out to be very high, then we can reduce the cash consideration a little bit, 50,000. So the purchase consideration is 322592. Goodwill so calculated is belonging to parent only, 322592 plus 48,400 minus 242,000. This is the value of goodwill. So this is the way we calculate goodwill. In the new purchase goodwill method, we fair value the net asset subsidy. We use this information in the calculation of goodwill, fair value of net asset subsidy, and the goodwill so calculated, if we are valuing NCA on proportionate basis, is known as partial goodwill. If the same, we would have compared it if NCI was valued at fair value, then the same would have been presented like this: purchase consideration, which is equivalent to 322592, value of NCI on fair value basis, which is 20,000. Suppose 3 per share is the value of share of NCI. It turns out to be 60,000. And comparing it with fair value of net assets of subsidy, which we just calculated in working note number 2, which turns out to be equivalent to 242,000. So the same is valued at fair value. What difference does it make to the entity? The goodwill so calculated is equal to 322593 plus value of NCI minus fair value of net asset subsidy. This turns out to be the goodwill amount. This goodwill is full goodwill belonging to parent as well as NCI. This goodwill belonging to parent only when we valued it on proportionate share of net assets. So these are the workings we use to calculate goodwill. We value NCI. Now working note number 4 is the valuation of NCI. Now since I've reached it here, so let's complete it. Valuation of NCI. If valuation of NCI is done on proportionate basis, we could directly apply the percentage to net assets of subsidiary on date of balance sheet. The net assets subsidiary on date of balance sheet is equal to 255,600. So if I apply directly 20% of 255,600, it turns out to be 51120. But since the manner of presentation changed when we decided to also give a choice to fair value NCI, this was the way we used to do it earlier, proportionate share of net assets. But the manner of presentation has changed. Now we value of NCI on fair value basis. The manner changed with the change in the manner of presentation for goodwill as well. So in this we include value of NCI on date of acquisition. So let's first look at from the perspective of proportionate basis that how it is presented now. Value of NCI on date of acquisition. Value of NCI on date of acquisition or proportionate share of net assets is equal to proportionate basis, it is 48,400 plus share of profit of NCI, which we calculated in working note number 2, is equal to, we just calculated the share of post acquisition profit. Now if you notice here, we calculated net asset subsidy on date of acquisition, date of balance sheet. The difference between these two figures was post acquisition profit, in which NCI has a share of 2720. So the total value turned out to be equivalent to 51120. So if you notice, there is no difference between this calculation 51120 plus this calculation. It's the same. Now if we value NCI on fair value basis, value of NCI on fair value basis. The value of NCI on fair value basis included on date of acquisition value of NCI on date of acquisition on fair value basis is equal to value of NCI on fair value basis on date of acquisition is equal to 60,000. Now for introducing this manner of presentation, we have started presenting proportionate basis value of NCI also in this manner. So this is the new manner of presentation for valuation of NCI as well. We could have directly done it, if you notice, like we could have directly done it by applying the percentage on the date of balance sheet. The date of balance sheet figure was 25560. That's the purpose of calculating it. The 20% of this value is 51120. But since we introduced the choice that will be valuing NCI on fair value basis as well, this is the new manner of presentation for Goodwill. We are presenting it like this by comparing 80%, 20%, and then comparing it with 100%. So in the valuation of NCI as well, we'll be presenting it in this manner to avoid any confusion and to achieve better comparability. The share of profit of NCI share of profit of NCI is equal to share of profit of NCI, which we calculated in working note number 2. It is 2720. So the total value turns out to be 60,000 plus. In the fair valuation side, there is one more thing which could be included, that is impairment of goodwill. Impairment of goodwill. NCI share. Suppose I assume goodwill is impaired by 10,000. So parent share will be 80% of 10,000, and NCI share in this impairment will be 20% of 10,000. This is only applicable to NCI valued on fair value basis minus 2,000. $60,000 plus 2720 minus 2,000. This is the NCI on date of balance sheet according to fair value basis. If NCI is valued on proportionate basis, we do not charge any impairment related to goodwill to NCI valued on proportionate basis. Only if it is valued on fair value basis, we need to be careful that if there is an impairment of goodwill, we need to allocate the impairment loss to NCI valued on fair value basis as well. Working note number 5 is group retained earnings, which is consolidating whatever we have done till now. Group retained earnings. So since this is all related to calculation of goodwill, has an impact on the calculations. The valuation of net asset subsidy determines the calculation of goodwill. Then the working note number 3 helps us to calculate goodwill, and this has a relationship with the valuation of NCI, so I thought to share these 5 workings as well along with what I did now. So in group retained earnings, we include parents' earnings, we include share of profit of subsidiary. Share of profit of subsidiary we calculate in working note number 2, which will be picking it directly from here. In working note number 2, we shared this profit of subsidy 10880. If there is any deferred consideration, we'll include the deferred consideration here. Unwinding of discount on deferred consideration. If you noticed, we had a deferred consideration as part of our calculation, which was at 92592.5. 8% of 92592.5 is equal to 7407 is the deferred consideration. If there is any change in fair value, of contingent consideration. Suppose the contingent consideration increased from 20 to 29. We included in our calculation contingent consideration at 20,000. Suppose this has increased from 20,000 to 29,000. So which has increased our liability on the face of the balance sheet. The increase in liabilities is also as an expense. So we increase it by 9,000. Any impairment of goodwill less impairment of goodwill, which we just calculated. Impairment of goodwill belonging to parent is 8,000 and 2,000. So we charge impairment loss here. So this is minus 7407. This is minus 9,000. This will be minus 8,000. And if I assume parents' earnings to be 1,50,000, just as assumption, so the total will represent the group retained earnings to be presented on the face of the balance sheet. So these are the 3 crucial workings for the purpose of consolidation, that when we are presenting consolidated financial statements, in the equity portion, the main thing which changes is when we present the equity and liabilities portion in the consolidated balance sheet. These are the main workings which require attention. One is goodwill, which is working note number 3 according to us. In the equity and liability side, it is share capital of parent only. Why share capital of parent only? Share capital of subsidiary or the net assets on the date of acquisition, they get cancelled. If you notice here, we calculated the fair value of net assets of subsidiary on date of acquisition. So these were the net assets on the date of acquisition. They got cancelled with the investment in subsidiary. The investment in subsidiary is 322592. So in the parent's books, the investment in subsidiary and the net assets of subsidiary, they are asset of one entity and liability of another. So investment in subsidiary is representing the asset of the parent. The net assets of subsidiary on the date of acquisition represents kind of liability of subsidiary. They get cancelled with each other, and the remaining amount which is presented in consolidated balance sheet is goodwill. Is the reason share capital of subsidiary got cancelled with the investment in subsidiary. We present only share capital of parent only. We'll be presenting group retained earnings, which will pick from working note number 5. Suppose this is 136473. Then we'll present Non-controlling interest, which we'll be picking from working note number 4. Suppose I take the fair value basis NCI, that is 60720. This is the importance of calculation of goodwill and how it impacts other valuations. So hope you have got better insight on goodwill, how it changed, what mattered, and why the manner of presentation is including NCI valuation, and why even NCI is valued through this manner. It could have been done directly. So mathematically, if NCI is valued on proportion basis, we could do it directly, but we are presenting it in this manner because there is a choice given for valuation of NCI either on proportion basis or either on net assets basis. So this is all for it. Thanks for your valuable time. To know more about me, you can have a look at my profile on Unacademy and LinkedIn with the name ACCA Amit Kumar. And to subscribe to my courses, use the code ACCA Amit to get instant discount. And do not forget to follow me on Unacademy. If I share a brief about me, this is ACCA Amit Kumar. I'm a member of ACCA UK. I've been training chartered accountants, finance and accounting professionals on the subject of IFRS in India since 10 years now. And I've worked with various corporates in the last 10 years. So my profile has been a blend of corporate experience plus practical exposure on Ind AS and training chartered accountants, finance and accounting professionals on behalf of parent corporation, was part of XSS consulting and was representing KPMG as one of the lead trainers on IFRS at Delhi during the peak season of IFRS, that was in the period 2014 to 16 when India was actually implementing Ind AS. Till recently, I was director with Accounting Advisory Services BDO India and was head Learning Solutions Pan India for IFRS trainings. I'm also an author of a book on Ind AS known as Ind AS Conception One Day. So this is all for it. All the best wishes for your examination. Your success is our success. With this, I come to the close of the session. Thanks for your valuable time. See you again.